what I was going to talk about is these are not predictions, because as we know, predictions are a mug's game, aren't they?
That's why I do them every day.
But this is just some observations. So I think some reasons to be cheerful for 2015.
Right.
So I think the first one is that from all the things that come across my desk, you know, you see a lot of statistics, you see a lot of anecdotal stuff as well. And I think that things might actually be starting to pick up in the wider economy. And that sounds a bit strange, considering we've had this really robust growth over, you know, the last sort of year and a half, 2 years. But a lot of that hasn't really fed through to normal people. The recovery's been great, I think, if you're already wealthy, you live in London or the South East, and you've got a big mortgage. If you don't fit into those categories, then there's a lot of people, our readers especially, saying recovery, what recovery? But I think there's a few things feeding through that show that stuff's starting to pick up. Some of those sort of cyclical stocks and indicators. So Topps Tiles reporting sales up 7%. So that's people going out, doing up their bathroom because they feel they've got a bit more money. It also reported this sort of rise in do it for me, which is people paying tradesmen to do the work for them. DFS put something out the other day saying that they've got sofa sales or sofa orders being made up 13% year on year. Again, that's people feeling a bit more confident, splashing out on the home. And then there was another report today from Manpower saying that businesses are most confident in taking on new people for the last 10 years. And the place that stood out in that was the Northeast, which is back to 2007 levels. And amongst that as well, there's this big demand for tradesmen, builders, plasterers, electricians, all that kind of stuff that indicates that things might be getting slightly better for people.
So this is real, these are real things. These are not sort of fluff in the city or, you know, it's actually sort of grassroots improvement.
Yeah, and I think that's really important, because I think that what we've seen is this sort of recovery without any recovery in wages. If you look at wages adjusted for inflation, they're back, you know, 2005, 2004 levels. And that feeds through to the next thing that I was going to say, which is the falling oil price and low inflation. Now, people are looking at the falling oil price, the city's looking at the falling oil price and saying, well, this is bad news. This indicates weak global demand. But I think we've got to remember that that feeds through into lower petrol prices and lower energy prices. And to be honest, that can only be a good thing, I think, for the consumer at the moment, who has seen a real squeeze from those things. And also, whilst we've seen, you know, a recovery, they've seen relatively persistent inflation. Now, low inflation, economists don't like it, but consumers do like it. And because wages haven't been rising, there's been this squeeze on household budgets, and that's starting to ease now. And again, I think that's going to help make businesses more confident, and businesses possibly think, well, if the consumer's spending a bit more, maybe we can give people a pay rise.
But isn't it the wage issue is one that just doesn't seem to want to sort of go away? I mean, you know, we probably are 20%, 30%, you know, poorer in real terms over the last 10 years. Luckily, prices haven't gone up, but you know, if they had, we really would be squeezed. There is some money to be made or taken out of, I suppose, remortgaging your house because the prices have gone up there. But otherwise, there haven't been the sort of the big drivers really in terms of getting the economy or the high street going.
No, and if you look back at a chart of if you plot wages against inflation, then there's been that relationship going back over the long term where wages were rising just that little bit above inflation. So every year you were genuinely getting a pay rise and your pay was keeping pace with inflation. I mean, that stopped 2007, 2008, and wages have been rising slower than inflation over that whole period. And whilst inflation hasn't been exceptionally high, you know, it floated up to that sort of, you know, 4% kind of level, it's been enough that it's just this constant grind on people. And this question of, you know, why with unemployment so low aren't companies paying people more money? And I think that probably feeds through into companies still being concerned and also being concerned that consumers aren't really spending any money. And I think that actually maybe that's starting to turn around and maybe we can be a bit more optimistic.
But we've got sort of, I mean, the inflation rate is like sort of around 1%, but you've got some, you know, some things, middle-class pursuits like school fees, you know, private school fees, they've gone through the, I mean, they literally have gone through the roof. I mean, they've gone into the, like, sort of house prices or something like that. And then maybe other things, which may be white goods and the things you buy every day have actually gone down. The sofas have gone down by a third or even more. So it's actually a sort of, it's not, we have inflation. The inflation rate's actually in the middle, but you've got some things where there's pricing power which have just gone through the roof, and some things have just completely collapsed. So which you can't really see from the headline figure.
No, and it's really difficult. And people say, well, this inflation figure, you know, so when inflation was, CPI inflation was around 3%, people were saying this does not in any way reflect what is happening to my spending. My spending is going up by much more than that. And people saw, you know, food, those everyday essentials that they have to be spending money on. So food prices, energy bills, and petrol prices. You know, those are the three big things that people really feel the squeeze from. Those were all going up at a fairly substantial clip, even when the economy wasn't doing particularly well. Now, interestingly, all of those things have turned around now, and I think that's going to feed through to people feeling like they've got a bit more money in their pocket.
Right, so the niggly things, the things which are really sort of looked like they were sort of incurable, have actually started finally to tip down to the...
Yeah, I don't think that anybody expected the oil price to fall as low as it has done. And there's this suggestion, oh, well, the falling oil price is bad news because, look, it's an indicator of weak global demand. Well, it's also worth pointing out that the oil price managed to climb to a pretty high level of over $100 a barrel whilst there was weak global demand. So maybe it should never have gone as high as it did. And I think the other reason that I was going to say to be cheerful is for investors, for long-term investors. The UK stock market looks decent value. Now, I wouldn't say that it looks, you know, fill your boots value or sort of, wow, you know, pile in, it's super cheap as it did after the, you know, after the financial crisis crash. But those moments don't come around that often, and you can sit there waiting for them for a long time. But if you look at the UK market on sort of long-term valuations, like the cyclically adjusted price for earnings ratio, it looks pretty cheap. The US market looks expensive and has only been more expensive during the peak of the dot-com boom and the late 20s. But the UK market, on the other hand, is below its average level. And that doesn't mean that this is, you know, a great time to be like diving in, but it does mean that if you're going to be that regular investor looking at 5-10 year horizon, regularly putting money in every month, building it up, reinvesting the dividends, and you're willing to put up with the dips, then this doesn't look like a bad point to be investing. And that's good news for people's savings and pensions.